Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work through a consolidation which has a parent and subsidiary relationship, two sets of books, two sets of trial balances we will be combining together as if one. There will be a non-controlling interest involved. In other words, the parent does not own 100% but does have a controlling interest, that being over the 51%. There's also going to be an intercompany transfer of equipment or depreciable assets. That's going to be the new thing that we're going to basically be focusing in on here. We're also going to have goodwill impairment as well as we go through the practice problem. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information on the left. We're going to enter that information into the blue area on the right. We're going to have our worksheets, and then we're going to have our consolidation worksheet where we have the numbers for both P and S as of the date that we are consolidating. Let's go on back to the data on the left and see what we have. We got P purchased, percent of S, P the parent, S the subsidiary. Common stock, that happened on January 1st, 2000 X0. Percent purchased 80%, therefore there will be a controlling interest 80% and non-controlling 20%. The cost was $182,000 at the point in time of purchase. The non-controlling interest was $45,500 at that point in time. Net assets at the point in time of purchase of S, meaning assets minus liabilities or equity section at that time, book value $150,000. We have the fully adjusted equity method is going to be used by P to account for their investment in S. The consolidation will take place as of 2000 X4. That's 5 years later because the purchase took place in January of 2000 X1. We're talking December now, 2000 X4 here. The book and fair values are the same for assets and the liabilities at the point in time of purchase. Therefore, we will not have to revalue the assets and the liabilities. So that's going to be a nice, it'll make it a little bit easier here. And then we have at the end of 2000 X4, goodwill impairment loss. There was a goodwill impairment loss. So what does that mean? That means there must have been goodwill. So we'll calculate goodwill and we'll think about what that is. Goodwill can be on the books indefinitely unless impaired. We're saying it was impaired at this point, impaired in the current year that we're consolidating. So we'll have to deal with that. Then we have the 2000 X3 S sold land to P. This is kind of one of the new things that happened here. We have a sale that took place of land. So land, this is a land that's being sold from S to P, so subsidiary to parent, upstream type of sale. Note, however, the sale took place last year in this case, not in the current year. And if you're dealing with land, it should be a little bit easier because we don't have to deal with the accumulated depreciation and depreciation expense related to it. Then we have on January 2000 X4, the current year, P sold equipment to S. So this is a downstream sale, P to S, so parent to subsidiary. It was purchased 5 years ago. In other words, it was purchased by P 5 years ago. We do have to deal with depreciation and accumulated depreciation, so this is going to be more complex to deal with, and the sale took place in the current year, 2000 X4, the year of consolidation. We have the cost, we've got the useful life, the sales price. We will be using a straight line method to simplify things with regards to the calculation of depreciation and accumulated depreciation. Intercompany receivables and payables. There's an intercompany payable and receivable on the books, $5,500. We've dealt with that in the past, so we will deal with that again here. So that'll be great. That's one of the easier things to do, hopefully. So we're going to start off with our adjustment. Similar adjustment we saw when we worked with the inventory accounts or intercompany sales that are basically the inventory type of sales. Similar kind of process happening. We're going to be dealing here with the sale that took place in the current year, which is going to be the equipment. And we're going to do a similar adjustment to our first journal entry that we would consider when we do the consolidation entries. Notice it's a similar process we have here. If you sell inventory, you have a similar thing going on, right? If you sold inventory, then you're going to end up basically with a gain, and you sold something like an asset, inventory, so you got a similar process that's going to be happening. So we're going to have a similar setup with regards to our setup up top. So we're going to say that this is going to be the total, this is going to be the controlling interest and the non-controlling interest. I would set up your worksheet and get used to a similar format as this. We're going to take the net income, which is going to be our starting point for the first entry, and then the ending book value, which is our starting point, and then make our adjustments to it. To do that, let's hide some cells up top and take a look at our trial balances. So I'm going to put my cursor on I, left click on it, and drag on over to S, I to S, I to S. Let go. I'm going to right click the selected area so we can then hide it. And then I'm going to hide those cells. I'm going to hide those cells. Then we're going to say, all right, now we got our information over here. S's books. These are S's books as of the point in time we're doing the consolidation 2000X4, 5 years after the purchase of P, 80% of S. Then we're going to say the net income down here. Net income, revenue minus expenses, this minus this, credits winning, income not a loss, 73,800. We're going to be picking that up. That's usually our starting point. So I'm going to say the starting point for the first journal entry is usually that 73,800 that we kind of think about breaking out between 80-20 controlling, non-controlling interest. So that I'm going to take that number times 80%, which is going to be this 80%. And then I'm going to take that number, I'm going to calculate it this way, times 1 minus 80, which is 20%. So that if you're working with this worksheet in Excel, hopefully that'll help you, give you a little bit more information. Then we want to think about the gain on the equipment down. So I'm going to think about the sale of equipment. To do that, let's go down below and actually do the calculation for the sale and think about what would happen with regards to the sale. We sold equipment. You're kind of thinking we sold equipment to ourselves. So what would that do if we sold equipment to ourselves? All right, well, we're going to say the sale of equipment. The sales price, I'm going to put this in the outer column, we're going to say the sales price of the equipment down here is going to be 71,000. I'm going to highlight this information green so we can kind of focus in on it. I'm focusing in on that information, the green stuff. That's where we're at. Then we have the basis, which is, or the book value we could say, which is going to be equal to the cost we originally cost of the 82.5, then the accumulated depreciation. Now notice in practice, we can kind of look this up a little bit more easily than we might do for like if we sold inventory, because usually when you sell equipment, you can actually look in the books. And it's not like it's an accumulation of transactions, like 10 transactions a day. It's only a few transactions. So this intercompany transaction, in other words, is not going to be an accumulation of multiple transactions as it could be with the sale of basically like inventory. So we can actually go in and look at the equipment sale more easily oftentimes, although the equipment sale could be more complex in nature. So in any case, keep that in mind. But we'll have to deal with the accumulated depreciation, which is the added complexity with regards to equipment. So the accumulated depreciation, we're going to use a simple straight line method. I'm going to say it was 82.5 divided by 15 times, we're going to say 5 years, times 5 years. Now in practice, we would probably have what the accumulated depreciation was at the point of sale when we looked up the transaction that took place at that point in time. We're going to do our calculation here so we can easily see on a straight line basis the 5-year depreciation before, and then the rest, we're going to have 10-year depreciation then after that point in time that we're going to be considering the 15 minus the 5. Subtracting that out, we're going to say the 82.5 minus the 27.5, that's going to be the 55,000 basis, or the book value. So then if we subtract this out, the 71,000 minus the 55,000, we're going to have a gain of that 16,000. So we're going to say that's what took place on the sales side on P side. Now it was sold to S, so on S's side, they're going to put it on the books with a debit to the equipment and a credit to cash. Now there was also added depreciation that we want to consider. So as we're here, let's consider that now that we're here. We're going to say, all right, this 16,000 is going to go on the books. Let's actually think of the journal entry here for P. So if I consider the same things in terms of a journal entry, I'd say, all right, well, they're going to get cash of the sales price. The equipment's going to go off the books for the equipment amount, 82.5. The depreciation is going to go off the books. It's a contra account or a credit balance account. So the book value would be these two at the 55,000. Gain then would be a credit, negative sum on the gain of the 16,000. So that's what would be recorded in terms of debits and credits by P. What would be recorded by S? Well, S then would record the equipment going on the books now for what they paid, 71,000, and then the cash would go out 71,000. So if we were to kind of squish these two things together and say, all right, well, if we were to reverse this because it was an intercompany transaction, you could say, well, you should just reverse both of these things. But really, we're going to try to net this thing out and say, well, what things do we need to reverse, right? We've got cash and cash nets out, equipment and equipment down here. we could see the equipment is now overstated by the 11,500. Then the depreciation has basically been, removed from the books and has been combined in this net value that it was purchased for. So we're going to have to basically put the depreciation back, the accumulated depreciation back on the books. And then we've got this gain that really never happened because the gain is an intercompany gain, one that's going to itself. All right. And now we also know that this is now on the books for something higher than the current book value, which it should have been, which was this minus this, or the 55,000. So this is on the books for a book value that is higher by 16,000. That means that we're going to be calculating depreciation based on that extra 16,000, which shouldn't happen either. So the current year, we're going to have this depreciation on the 16,000 that's too high that we'll have to also be dealing with. So let's put that here. I'm going to say, all right, there's a 16,000 increase. I'm going to take that 16,000. And when I think about that increase, I'm thinking about it now as the cost being at the book value being 16,000 higher. We have a remaining amount of depreciable life, which is the 15 years minus 5, 10 years left to depreciate. That added 16,000 is going to result in 1,600 too much depreciation calculation that we're going to have to deal with as well. Okay, so given this information, let's go back up top and think, all right, well, the gain on the equipment, I'm going to say gain on the equipment down because it was a sale from P to S. So that's what the down is going to stand for. I'm going to say that that's going to be the gain of the 16. So I'm going to pick up this 16,000. Now, because it's a down transaction, we're just going to put that entire 16 to P. We're not breaking it out, controlling, non-controlling. We're not breaking it out between the 80-20. We're just going to allocate it all to P. Also note that if you're comparing this to the prior things we did with the inventory, with inventory, we had like the reversing transactions from like prior year transactions that weren't sold yet and whatnot. Here, we're talking about this transaction happened in the current year. So this is a current year transaction that we are in essence removing, which were kind of like the bottom two items we dealt with in the same kind of table for the inventory. Then we've got the extra depreciation down, meaning from a sale from P to S. This is going to be a positive in our calculation of that 1,600. Once again, because it's a down transaction, P to S, it's all going to go to P, not breaking it out 80-20. Then we're going to be summing up. So let's go ahead and sum this up then. And we're going to say there's the sum and the sum. We could just copy this across, but I'll do it one at a time just so we can emphasize that we're summing up the columns here. And then we're going to do the same thing for the second half, but starting with, instead of net income, the book value or assets minus liabilities, not at the point in time the purchase took place, but at the point in time that the consolidation is taking place, in this case 5 years later. Assets minus liabilities, the 249,000, or equal to the equity down here, the 249,000. That's our starting point. We're going to say this is equal to the sum of the assets and the liabilities. Assets and the liabilities. So there we have it. And then we're just going to start off. We would break that out 80-20 normally. So that times 80%. And I'm going to calculate this as this times 1 minus, let's say, not 1 minus the 80 or 20%. So there we have that. So then, of course, that and that equals the 249 here. Then the filler is just the same. So then we're just going to say this is kind of like the other side of that beginning entry that we're going to be doing. So this is just the other side. I'm just going to sum it up this way. Same numbers. Same numbers here. Then we'll sum it up this way. Sum it up this way. And sum. I'm just going to sum each one of them just to emphasize that we're summing this up. So there's going to be our table that's going to help us with that beginning journal entry. Okay, now we're going to unhide some cells up top. I'm going to put my cursor on G and highlight over to T. From G, left click to T. Let go, right click, selected area, and unhide. So then we want to think about this first entry, this calculation of goodwill. So we're going back to, okay, what's the calculation of goodwill? We would probably do this at the first time of consolidation, and then we would have it in our worksheets, later, 5 years later, we'd still have the calculation of goodwill. So the goodwill calculation, we're going to say, all right, well, we purchased this thing the net assets at the point in time of the purchase was 150, meaning assets minus liabilities or book value at the point in time of purchase. There was no difference between the fair value and book value of the assets and liabilities, so we have no adjustment there. The non-controlling interest at the point in time of purchase 5 years ago, 2000 X0, was $45,500. Therefore, the controlling interest would be the 150 minus the 45.5, the difference of the two. That's how much you would think would be paid by P for the 80% if there was no goodwill. But P paid, and when I say we, I typically mean P, we're the parent. Then we paid $182,000. That means the goodwill should be the 182 minus the 104.5. Therefore, there's goodwill that we're going to have to account for, $77,500. So we'll have to deal with that, and we'll have to deal with the fact that in the current year, 5 years later, there was an impairment this year for some reason of $20,250, which is going to result in an impairment loss. We're going to consider that shortly because we'll think about that in our equity method calculation. So let's think about the equity method calculation. I'm going to hide some cells over here. Let's hide from P to S. I'm going to left click on P, right, and then scroll on over to S. Let go, right click the selected area and hide those ones. So now we want to reconstruct basically this number for the investment, at least for the current year that we're working on 5 years later, 2000 X4, and this one for the income from S. That'll help us with the consolidation process. So what would S have done? We're reconstructing them. We're not going to post this. We're going to reconstruct to get to those two numbers using the fully adjusted equity method. Well, normal equity method would mean when S recorded this net income, P would record their portion of it, 80%. So they would normally say, well, the investment must have gone up in the current year, and then we're going to record the income from S, because we're P of that, and that's going to be for the amount of the 73,800 times 80%, our percentage. We have 80%. So there was that. That's the normal equity kind of thing you do. Normal equity stuff. And then we would take the dividends that got paid. So dividends paid from S to P, we got 80% of them because we're P and we own 80% of S. So we're going to say the dividends, we're going to say we got cash dividends, let's say. And the other side is going to be investment going down. For our portion of the dividends, us being P, we got 5,000 times 80% because we own 80% of S. We have a controlling interest over 51%. So then that's going to be the normal kind of debit and credit that we would have. Okay, so now let's think about some of the other things that happen to basically the income statement that aren't on S's books, but then we're going to have to adjust for because we know they're going to be involved in the consolidation process. One is that impairment in goodwill. We know we had that impairment in goodwill. So what would that mean? This will make more sense when we record it, but we had goodwill that's going to go on the books at $77,500, but then in the current year, it was impaired by $20,475. How are we going to adjust for that? We're going to have to credit goodwill and debit like an expense or a loss account, which is going to hit the income statement, which is going to mess up our equity method calculation. So we're going to have to account for that in our fully adjusted equity method. So we're going to say, all right, well, that would kind of lower our net income calculation. So we're going to say that's going to be a debit to the income from S because it's kind of like an expense thing that would happen. And then we're going to credit our investment because it's going to go down by this impairment of our asset that was in S's goodwill, and it's going to be for that $20,475 because this isn't what the goodwill was impaired to. This is the impairment. This is how much it went down by times 80%. So that we have to deal with that. All right. So that's going to be the debit and the credit. And then we have this 16,000, which was basically this gain that we are in essence going to remove. It was a gain that was on S's books. It's included here in the current year, and we're going to have to remove it. So we're going to say, all right, well now our portion of the income is too high by the amount of the gain that we're going to have to record, which we already calculated is going to be this 16, and then we're going to credit that 16, and that's going to mean the investment's also going to go down. So that is something there. And then we had the current year depreciation on that added 16 as a result of this intercompany sale that S is going to record, because they're going to record too much depreciation because they now have the equipment on the books for $16,000 higher than what the equipment really should be if they didn't sell it to themselves in this intercompany sale. So we're going to have to remove that, and that is an expense. So they've overstated, in essence, this depreciation expense. Included in that $12,000 is an overstatement of that $1,500. So we need to remove or reduce the expense, which is kind of like an increase in the net income. So then this would be a debit to the investment, and the income account and income from S would basically be going up from this one. And that's going to be for the 1,600, so the 1,006 and the 1,600. All right. Okay, I think that's it. So let's see if this ties out now. So let's just add these up and say, all right, let's just add up like the income ones, and say if I add up all the income ones and say this plus this is an income plus this one and this one, that adds up to 28,260, which ties out here. So we've reconstructed that number. And now let's add up the investment ones. These won't come out to the same number, but we can at least kind of add them up and see what we got so far. This is this one plus the investment, plus the investment, plus the investment, plus the investment. So that's the 24,260. Doesn't tie out to here because this is a permanent account, and it's going to be calculated since the point in time that the consolidation took place 5 years ago. But given the fact that this number is right, we can think we're on the right track as to how that number is being calculated. Now let's unhide some cells. I'm going to highlight from N to T, highlighting from N to T, let go, right click, and unhide. All right, now we're getting into the actual consolidation worksheet here, which is exciting. This is the moment that we have been waiting for. So now we got P's books and S's books. We're going to add them together. We're going to consolidate them. So that'll be our first step, as we've seen in prior practice problems. So we'll consolidate those. So let's sum them up. I'm just going to sum them up, these two columns, and we're going to add them up. And then we'll paste that on down. Add them up, paste them on down. There it is. That's our starting point. Now we're going to enter our consolidation entries. The first entry is kind of like the most complex entry that we're going to basically adjust now with regards to our table. So let's think about the normal entry we would think about. We kind of remove the equity accounts and whatnot normally. So we're going to say, and I usually start with this one just to put it up top, even though I'm not going to put a number in it yet. But that's just the first one you see. So I usually start with it. And then I'm going to remove the common stock, retained earnings, and dividends. So that means these accounts are going to go away. We got to remove S's portion. So I'm going to say, all right, common stock, retained earnings, and the dividends. And the common stock is on the books for a credit, so we're going to have to debit it. So we'll debit the common stock for the 100,000. The retained earnings on the books for a credit, so we're going to debit it for that 80,200. The dividends are on the books as a debit, therefore we will credit it for that 5,000. So that'll bring these amounts, basically take these off the books, resulting in the ending balance matching basically P's balance over here. Then we typically think about the income from S. So income from S in our normal calculation here. I'm going to do the normal calculation, and then we'll make the adjustment for it. Normally, I would take the net income, which is of S, revenue minus expenses, times their portion, the controlling interest in this case, 80%. But we're going to adjust this now to what we did over here. So I'm going to say, over here we said this is the 5940. That would normally be here, but we're going to adjust it to this in accordance with our table. So we're going to adjust basically these guys using those numbers. So I'm going to say, all right, this is now, I would have picked up that, but I'm going to now do that. And I'm going to make this green so we can say that, okay, I'm pulling these from the table now. So the green ones are the ones we're pulling from the table. And then normally we would then do, okay, now I'm going to do the non-controlling interest, the 20% of the net income. So I'd say, all right, then I'm going to take this 73.8 times 1 minus the 80%, which is there, or 20%. And that's what I would normally do. But I'm going to take it from the table, even though the table here is the same number, just so we emphasize we would be taking this from the table. I'm going to say, no, I'm not going to take it from the table now. That's what I'm doing. So I'm going to say this is going to be from the table. And I'm going to make that green to emphasize the fact that that's a table number. Then we think about the balance sheet side of things. I'm going to take the non-controlling interest on the balance sheet, or net assets, and you'll note that if I add up the net assets here, they add up to the 249,000, which is of course equal to equity, the 249,000, and that would add up to the middle column here, except that we have now adjusted these two numbers, so we're going to have to basically adjust for that. So in other words, we normally would have done the entry that would look like this. It would say negative sum of assets minus liabilities times, and then normally it would have been like 1 minus the 80% or 20% here. That's what we normally would have done for the 49.8. So, but if I go over here, there's the 49.8. Now this happens to be the same transaction because again, we didn't adjust it, but this one will be different. So although it's the same, I want to pull it from the table. I'm going to say that's the same, but I'm pulling it from the table here. This is a table number. And then the other side would typically go to the investment. And that one would normally be the other side, which would be the 80% negative sum, or not negative. I'm just going to say it would equal the sum of, oh, it would be negative. Sorry. Negative sum of assets and liabilities, and then times the 80%. The 80%. That's what it would normally be. But if I go over here now, we're going to pull that from the table. That's what it would normally be here, but now we're going to adjust it to that. So I'm going to say, all right, now I'm just going to adjust this according to the table. It should all balance out because we did both sides of the table. So that's a table number. So this should be in balance now. So that's in balance. That looks good. Let's record that out. That's our main kind of difference that we've done here. So we should be good from here on. It should be easier. So we're going to say this is going to be the investment account. There's might be a little bit different going forward, so don't stop there. But investment in S is going to be equal to this 184.8. This isn't 0 yet, so we're going to have to keep going. The common stock, we're going to remove, in essence, S's portion to get back to P's portion. Then we've got the retained earnings, similar process. We're going to be removing basically S's portion to get back to P's. The dividends then are going to be removing, in essence, S's portion to get back to P's. You can see here, here's the P's, here's S, here's the total. Then we removed, in essence, S to get us back basically to P. So then we're going to go to the income from S. So income from S, and we're going to say that is equal to the 44,640. So now we're not at 0 there, so we're still got work to do. We're going to go to the non-controlling interest. Non-controlling interest 14,740, and then the non-controlling interest on the balance sheet side of things, which is here, and that will be the 49.8, and that should bring us back in balance. Okay, so now let's think about the goodwill. Now the goodwill, we need to put it on the books, and then it goes on the books. It would have gone on the books like 5 years ago when the purchase took place, when we do this consolidation. Not on any particular books, but whenever we consolidate, it would have happened at the point in time the consolidation or the purchase took place 5 years ago. And now it's been impaired. So I'm going to do this with 2 steps. I'm going to show the goodwill, and then we'll show the process of recording, the impairment on it. So normally we would say if there was goodwill, we would have this on, we would have seen this in last year's consolidation. The year before that, we'd say, all right, we still got to do the same goodwill thing. Goodwill would be going up, and it would go up by the goodwill that we calculated it to be, which was the 77.5. And then we would break it out now to the balance sheet side of things, between the controlling and non-controlling interest, controlling and the investment, non-controlling and the non-controlling NA here. So then we're going to say, all right, that's going to go to the investment for 80%, 20% to here. So then we're going to say, all right, so this is what normally would happen this time. Now note, you can kind of net these entries out, but I want to show the whole thing here so you can kind of see it. So that's going to be that. Then I could do the negative sum, or I'm going to take this times 1 minus the 80 or 20%, because I think that's easier to see if you're just looking at the worksheet. So there we have that. That should be in balance. So that looks good. Zeroes out. Let's record it. Goodwill then. Goodwill would have gone up because there's goodwill in S. And then the investment account is going to go up. I'm going to say F2 plus F2. We're going down, crediting it. So there is the investment account, and then the non-controlling interest in A, F2 plus F2. It's going to be the 15.5. So there we have that. That will then put us back in balance. Now there's an impairment that happened. We said in the current year, this year that we happened, 5 years later, it's been impaired. Now remember, goodwill doesn't necessarily go down ever, but we have to assess it, and we assessed in the current year that it went down. So now we got to record the loss or the decrease. So we're gonna say they could tell us what this amount should be or how much it went down by. They told us how much it went down by in this problem. So I'm gonna say, all right, well, how are we gonna we're gonna have to reduce this with a credit, and the debit's gonna have to be down here on the income statement somewhere, right? So the debit's gonna be like a kind of like an expense. It's gonna be affecting net income, and that's gonna mess us up because now we got this income's in the current year's been hit, so we got to make the adjustment to the non-controlling interest in what accounts. So we're going to say, all right, let's first do just the reduction. There's going to be this loss, and then we got goodwill, and that's going to be for the $20,475. That's what the impairment was, how much it went down by. So that's going to be the debit and the credit. So then we're going to record the gains. I'm sorry, that shouldn't be a gain. I picked up the wrong account. This is going to be goodwill impairment. So goodwill impairment. So we're looking for this account, the goodwill impairment. All right. So, and then we're going to go back on over into the goodwill impairment. It's going to act like a loss here for the $20,475. The other side reducing the goodwill. So goodwill here, I'm going to say F2 plus F2. We're going to reduce that $20,475. So now it's at the $57.25 in the goodwill. Okay, so because this happened in the current year, and because this is an income statement account, we now have to deal with the allocation of the non-controlling interest and the controlling interests. So I typically think of like the income statement side of things first. So basically, this is a loss that acts kind of like an expense. Therefore, you can see it's been included, like in our equity method over here. It's that 380, which is 80% of that. So basically, that's included in this number. So we're gonna have to basically credit it, to bring this on down. So I'm gonna say, all right. So we're gonna pick up this income from S. The calculation is going to be, I'm going to say, I could just say equals this times 80%. So I'm going to say 80% is here. And then we're going to pick up the non-controlling interest, which is going to be equal to the non-controlling interest. And you can see the non-controlling interest basically represents, its portion, the non-controlling interest portion of the net income with a debit balance. So it needs to basically go down now because of this. So we're going to say, all right, that needs to be decreased by, I'm going to pick up this times, I'm going to say 1 minus that 80%, 1 minus the 80% or 20%. And so there we have that. Now the other side is going to go basically to the balance sheet side of things. So the income from S is going to go to the investment. So the other side of this is in the investment in S. So that's going to be the debit. And the other side of this non-controlling interest down here is the non-controlling interest on the balance sheet. So I'm going to pick it up this way. That's how I would kind of think about it. And I know, again, I put the credits on top to do that because that's how I would think about it mentally. So I'm going to say, all right, so then the income from S is going to be here. So income from S, I'm going to say, and also note, obviously at this point, 16,380 is what we need to bring it down to 0. So you can kind of figure it out in that way too. So I'm going to say F2 plus F2 That's going to be the 16,380. And then we got the non-controlling interest here. That's going to be down here, non-controlling interest. I'm going to say F2 plus F2. That's going to be the 4,095. Then we have the investment in S. The investment in S is here. I'm going to say F2 plus F2. We're going to pick up that 16,380. And then we got the non-controlling interest here. So that's going to be F2 plus F2. We'll pick up that 4,095. Okay, so there's that one. Now the next thing we want to think about is there's that intercompany receivable and payable. In other words, we're saying basically like S owes P money. So that means that the receivable is overstated on P's books, the payable is overstated on S's books, and we're simply going to reverse those reciprocal accounts. Now you might say, when that happens, what about the inventory and the sales that took place? Notice we can kind of break the sales part out and think about them separately. It could be the fact that these receivables and payables happened from a prior year transaction or something like that. So we often think about them in a separate fashion. I can say, okay, well, here's the receivable and payable. If I look at the subledgers for the receivable and payable, I can see, that they owe each other money, and we can reverse that, and then we can reverse the sales that are happening, in the current and the prior year, and so on, the inventory and whatnot. So here we're going to do, the easier transaction we've seen in the past, which is simply to reverse the reciprocal accounts. So we're going to say, all right, the payable must be overstated, so it's got to go down. So it normally has a credit balance, so we're going to debit it. The receivable is overstated. It has a debit balance, so we're going to credit it for the amount that would be overstated, and that's given in the problem for the amount of the 5,500. So that's going to be the debit, that's going to be the credit. Let's go ahead and post this out. Here's the payable here. Here's the payable here. So we're going to say this equals the 5,500. And then here's the receivable. Here's the receivable. So that's going to be equal to the 5,500. Okay, so next we're going to think about the land. And so this is kind of one of the new things that happened. There was land that was sold, an intercompany sale of the land, but that happened in the prior year. So let's consider, so it happened in the prior year, and there's no depreciation because it was land that happened. So let's think about that. We're going to say, all right, well, let's go back to this land transaction. Happened last year, 2000X3. So once it happened, after a few years later, the land, we'd always have to make this adjustment for it. But after the year that the initial year of the transfer would result in a gain or a loss, possibly, that we'd have to account for in the initial year. And then in later years, it would basically be the same. We would have to do this adjustment every time the consolidation. All right, so then the land, if we thought about this land transfer, what would happen? Let's do the calculation on two sides of the book. So what they say is that the land went from S to P, so it was going from S to P, subsidiary to parent, so it's an upstream sale. And so if I record it down here, I'm saying, all right, on S's books, they're the one that sold the land. We're going to say that the cash would have gone up on the sale of the land by the 20,250. The land goes off the books the land would go off the books for the cost of the 9,000. No accumulated depreciation we have to deal with. Then we would have the gain. Negative sum on the gain is going to be that 11,250. So that's what would happen on the side of S, who sold it last year, right? So this gain that happened last year, which now we know rolled into retained earnings in the current year and on the balance sheet side of things. What would happen on P? Well, P would say, now P puts the thing on the books for what they paid for it, which was the 20,250, and then they would pay cash, let's say, here. So if I was trying to combine these, and I say, well, what if I net these out, what do we got to do to kind of reverse this if I was to distill this down? Well, cash is going to net out. So there we have that. We know the land then is going to be something that we had a decrease here of, let's say, 9,000 and then the 20,000. So let's make those the same color. So we're gonna have to deal with that, because now that the land is on the books for an added 11,250, and we're gonna have to decrease the land by that amount. And then we had, of course, this gain that was the other side, the result of this, the 11,250, and that gain shouldn't have happened. Now, of course, that gain, if we think about it as one company, that gain happened last year, so that gain is now into retained earnings. So we're not going to be dealing with the income statement this year. We're going to be dealing with basically just balance sheet accounts. Okay, so we're going to go back on over and say, all right, well, we know the land then is the first thing I would think of is overstated. So I'm going to say the land is overstated. So let's go up to the land, and it needs to go down. So again, I'm starting with the credit because that's the first thing I would think of in this case. So it's going to go down by the amount that we just calculated over here, which is going to be all the way at the bottom, isn't it? Down here for the 11, let's pick up that 11,250. So we got to adjust that, or you can think of it as the negative of this number. So that's going to be a credit for the 11,250. Then the other side, it's not going to be going between the income statement accounts because it happened last year and rolled into basically, you could think of like a retained earnings. So it's going to affect the breakout 80-20, but between the balance sheet accounts, which is going to be equal to the investment account and the non-controlling interest in the net assets, not the non-controlling interest in the net income. I'm going to calculate this as negative of this number times the controlling interest percent, which is 80%. So times the 80%. Then you can use the negative sum formula, but I'm going to use this formula. So when you look at this worksheet, I'm going to say negative that number times 1 minus the 80% or 20%. So when you look at the worksheet, you could see that. Hopefully that'll give you more information. So then that should be it. That should tie out. That adds up to 0. Let's record it. Land then going down. Going up to land, we're going to say it should be decreased by that 11,250. The investment in S, here's the investment in S. I'm going to say F2 plus F2. That's going to be the debit of the 9,000. Then the non-controlling interest in A is here. I'm going to say F2 plus F2, and that's going to be the 2,250. The 2,250. Okay, so we're going to do a similar thing now for the sale of the equipment. The sale of the equipment happened in the current time period. So when we think about the equipment, we know that we have this gain right there on the income statement. So the gain happened on the income statement. Now, we already thought about in the first journal entry, kind of like part of that, we considered the kind of the equity portion here in our first journal entry, but we still have to basically remove the gain and think about the machinery, the asset side and the accumulated depreciation side of things. Okay, so to do that, let's think about this transaction again, just real quick. We're going to go, all right, this equipment was sold. Here's the equipment that was sold. It was sold for $71,000, cost $82, accumulated depreciation. Therefore, the book value or basis here, gain 71 minus the 55. If we think about that in terms of journal entries, we'd say, okay, P sold to S. That means P said that they got a debit of 71,000. They got a credit of the equipment that they're taking off the books, 82.5. That's for the full cost of the equipment to them. They had accumulated depreciation on the books of 27.5, difference being the book value, 55,000, resulting in a gain of 16,000. What happened on S's books, the purchaser? They put it on the books for 71,000 because that's how much they paid for it, and then the cash for the 71,000 if they paid cash for it. So then what do we got to do to reverse this thing? Because this happened kind of like in the current year. Well, the cash is going to net each other out. If you think about this as one entity, the equipment account is going to basically net out here, but the equipment is actually understated, which again, you'd think would be weird if they had a gain, but that's because this accumulated depreciation being a separate account messes everything up, right? So we actually have to increase the equipment account, and we got to put the accumulated depreciation back on the books because P took the accumulated depreciation off the books. And then when S purchased it, they didn't put any accumulated depreciation on the books because it was a new machine to them. So we gotta put the accumulated depreciation back on the books and deal with that. And then there was this gain, and because this transaction happened in the current year, this gain is currently on the books, currently in the income statement, and therefore we have to remove the gain as well. Okay, so let's do that. That's gonna be great. So we're gonna go back on over here and say, how would we do that? So we might think then, I mean, the first thing you might think of is like the machinery. So you might say, all right, well, the machinery is going to have to go up. We're going to have to increase the machinery by the 11.5. The 11.5. So I'm going to say, where did I calculate the 11.5? Right there. The machinery is going to go up by the 11.5. I want to make that a debit. So I know that that's got to go up. And then the accumulated depreciation has to go up, and it's a contra asset account by that 27,500 to put it back on the books, because we removed the accumulated depreciation, and we shouldn't have because we sold it to ourselves. So the accumulated depreciation needs to go up by that 27.5. And then the difference between those two is basically the gain. So I'm going to say negative sum, or you can go pick up the gain, which is that 16,000, which is right there, which I know shouldn't be there because that gain happened. The whole thing happened from an intercompany sale, and that needs to go away. So I'm going to say, all right, we got to take that away. So that's going to be our transaction there. Now, note we've already accounted for like the non-controlling interest and this and that in this little worksheet that we did in that first journal entry. So we took these into consideration there. So we're basically, picking up the other side of the effect of that. Okay, so then we're going to go back down. Let's say machinery is going to be here. Go back up top. We're going to say, all right, the machinery is going to be debited by that 11.5. We got the accumulated depreciation. It's going to be here. And we're going to increase the accumulated depreciation, and then this gain needs to go off the books. That's got to be gone. No gain. No gain because it was a phantom sale, kind of. So then we're going to go over here, and then the last thing we got to do is say, okay, we also had the accumulated depreciation, which we calculated over here, which we said, hey, look, these P put the thing on the books for a book value. I mean, it really only had a book value of 55, and now it's on the books for 71, which is an increase of the gain of 16,000. And then they depreciated that increased thing over the useful life, which is 10 years left. 10 years left on the useful life because it had 15-year useful life, and 5 years had passed before the point of sale. So 10 years left. So that now there's included in the depreciation expense 1,600. Of extra depreciation, which shouldn't be there in the current year. So we're going to go, all right, that means that in this number, S recorded too much depreciation expense. We got to remove that. So the normal depreciation expense journal entry, we're going to reverse. And again, you'll see that we're kind of doing the other side of these two adjustments we kind of did here in our first entry. All right, so we'll reverse that. So normally we debit depreciation expense and credit accumulated. So now we're going to credit accumulated and then debit depreciation expense for that 1,006. 1,006 that we calculated. Where did we do that? I did that here somewhere. There it is. And let's pick that up. And so there's that. So now we're going to go up to the accumulated depreciation. I'm going to say, all right, F2 plus F2. And then the depreciation expense is here. And see, we're going to say this equals then the credit. And so that puts us back in balance. So note that these two should be basically zeroed out. Equity accounts here for P are basically the ending equity accounts here. And if this was not zero, you can kind of check and use your little tool here to see what's included in this account. And then you can go back up to these items and kind of tie them out, trying to reverse engineer, this number and then the effect on your fully adjusted equity method in order to get this basically back down to zero.